I'll get started. Well, I've just got a couple of things to say. I don't need my presentation just yet. I'm John Forwood from the Lowell Resources Fund. I think in Hamburg you say Moin. So good morning, everybody. Thank you very much to Michael Stuke for inviting us to come to the conference. Great to be in Hamburg. Before I get started, we've got a little booth outside. If you missed out on winning Guanajuato Silver's silver coin, we have another silver coin to win. So if you come past the booth, put your entry in, and that'll be drawn this afternoon. And we'll also be handing out a couple of bits of information about the junior resources sector. Okay, we'll get started. I've got quite a few slides. I'll try and get through them. Please, could you advance a couple of slides? Sorry? Right, I've still got to get up with the right date. Thank you for pointing that out. Could we have the... There we go. Great. Okay, so we're from the Lowell Resources Fund based in Australia. What I want to do this morning is just talk a little bit about, or show you that investing in junior resource companies can be very profitable, and it has been for the fund over a number of years. Then I want to talk about how we're positioning the fund a little bit at the moment, particularly in these very turbulent times, and what we're looking and what we have been doing in terms of investment at the fund over the last month. And then talk about some of the commodities that we have been trying to increase our exposure to. Is that going forward? Try that one. That's going backwards. Okay, try this one. So we're a fund. We just focus only on junior resources. We invest all over the world, and we invest in pretty much any commodity. We also invest in unlisted companies, seed opportunities, but mainly we're investing on the Australian Stock Exchange and the Toronto Stock Exchange. We pay a distribution every year. It's a bit lumpy, but over the last 6 years we've averaged 9 cents per unit of distributions per annum, and the current unit price, that's per unit, and the current unit price is a bit over $2 Australian dollars a unit. So the yield, which is unusual for junior resources, the yield of the fund is around 4 or 5% on average. These are the returns that we've been able to generate investing in the sector. So you can see those returns are quite healthy. This is net of all fees that the fund charges. And we've been around for a long time. So over 20 years, we've managed to do 19% per annum, which shows that this sector is something that can be very rewarding. There's a chart of our performance compared to some of our benchmarks on the Australian Stock Exchange. You can see strong performance, but a massive pullback in March, which was obviously very turbulent for world markets, and particularly junior resources markets. You know, for example, we saw the gold price come from $5,400 US an ounce back to as low as $4,100 an ounce intraday in March. So we're seeing a nice recovery at the moment, but yeah, March was probably the toughest year that I can remember for investing in junior resources. So actually not a bad time, in my view, to look at picking up some opportunities. This is what we like to do. This is what's called the Lassonde curve, named after the founder of the Franco-Nevada company, Pierre Lassonde. It's the typical life cycle, if you like, of a successful resources company moving from exploration through to production. And at the fund, we really focus on that first part of the Lassonde curve. which is the discovery and exploration phase through to proving up a resource. By the way, Pierre Lassonde is probably, in my view, the best forecaster of the gold price that I know. And his latest forecast for the gold price is $17,250 an ounce between now and 2030. And he's been right more than he's been wrong in the past, so I certainly wouldn't write off that gold price being achieved in the next 4 years. This is our portfolio. We're strongly biased to gold. We do love gold. 50% of the portfolio in gold and platinum group metals. 18% in copper, our next most favoured commodity. But then we can invest in anything, any commodity, hard commodity, including oil and gas. And what we are going to be looking at doing, and have been doing, is boosting the exposure to the energy sector, because I think there's a good possibility that we might be moving into a new energy bull market. And so that means things like battery metals, oil and gas, obviously, uranium, and copper, which is obviously very exposed to electricity use. Just having a little bit of trouble with the... and here's our portfolio broken down by stage. So as I said, we are very much focused on grassroots exploration and not so much on production. So I would say our fund is like a venture capital fund. We invest in pre-cash flow companies which have high technical risk, but they need to have, for us to invest, need to have a very big potential for a high return. And you're just showing where we invest, about 40% in Australia, 40% in North and South America, and the rest in Africa, Asia, and a very small amount in Europe. And most of our investments are held on the Australian Stock Exchange, but quite a few in North America as well. Okay, so this is our top 10 holdings. Some of you may recognise some of these companies, but at the top there's two interesting columns. One is the estimated price to underlying value of the project that these companies are involved in. And so generally the lower the better. So 0.1 PNAV means the company is trading at about a valuation of 10% of the value of its underlying project. So that's what we like to see. We like to see if it could achieve its full valuation, that's a 10 times, potentially a 10 times uplift. And to get there, the next column is very important, the market cap divided by capex, which means that if you've got a higher market cap compared to how much you need to raise to put that project into production, you've got a greater likelihood of being able to raise that money. So the higher that ratio is, the better. And you can see from that chart that we also have quite a bit of exposure to companies that don't have any economics around their projects and are just really explorers. So why do we invest in the junior companies? And we're generally looking at companies which have a market cap of less than $200 million, Aussie or Canadian dollars. So invest in the juniors because they're the ones that make the lion's share of the discoveries. And that's where the massive upside comes from investing in junior resources, is when you make a discovery. So, oops, sorry. Just going back, I'll just go back to this slide. These are the new investments that we made last month in March. So you can see a spread of commodities that we've been adding to the portfolio, increasing in the portfolio. There's uranium, gold is always popular with us, but oil and gas and lithium and copper in particular. So they're the commodities that we're trying to increase our exposure to, and we're going to be doing that going forward as well. I think, and you can see the market caps of those companies. all less than 100 million Australian dollars, which is about 70 million US dollars. We're trying to get in on the ground floor and take the risks that, commensurate with that low market cap, but also hopefully very, very substantial upside. So this is probably the most important chart that I've got to show. And I think it's very important for anyone who's investing in junior resources companies to be mindful of this chart. And it's really the relationship between the value of junior resources companies. This is the green line, or the dark line is showing companies in Australia, junior companies in Australia. And, the yellow line is showing junior companies in Australia. The dark line is the US Fed funds rate. That is you can see there's quite a strong inverse correlation between those two. So when the Fed funds rate is high, it's not good for junior resources, not good for any non-yielding investment, such as gold or any sort of venture stage investment. But when the outlook for interest rates is coming down or is low, then there's money that flows into those sectors. So it's in this sense, it's pretty simple. You need to have an outlook, have a view on what the US Fed and other interest rate setters are going to do. So just in that regard, I think we're all aware, diesel fuel prices have gone up significantly, and particularly in the US. The US is the world's biggest energy producer, but it's not insulated from world prices for oil. And that is going to be feeding, or has been feeding into inflation. So you can see the black line is West Texas crude oil prices, and the green line is a proxy for inflation in the US, and there's quite a strong correlation. And just overnight we saw that inflation in the US has jumped up to 3.3%. I don't think there's any surprise about that. And then this is a chart which shows in the grey bars recessions, and the green line is deviations from the mean in terms of the oil price. So a strong correlation between when the oil price jumps and an ensuing recession. So I think central banks have got a really tough job. They always got a tough job, but at the moment they're caught between a rock and a hard place, in that we've got looming inflation, but we've also got a looming recession. Do they try and squash inflation, or do they try and boost growth with what they do with their interest rates? At the moment, most central banks are sitting on their hands. The ECB, US Fed has said, well, we're just going to do nothing, wait and watch. But I think you need to have a view on what's going to happen there if you're going to be investing in junior resources. Oops. Turning to gold, this is a very interesting chart, I think. Strong correlation between interest rates or inverse of interest rates and the gold price up until the start of the Ukraine war. When the Ukraine war broke out, there was a very strong de-dollarization which happened. But in March, we saw that reverse. We saw that re-correlation start to pick up again. The question is, will that continue? Will that re-correlation between inverse interest rates and gold continue, or will it start to break down again? I think I'm in the latter camp, that the fundamental drivers of de-dollarization have not gone away just because of the Iran war, and we will see that de-correlation continue. So just looking back, just in terms of the gold price, which is the yellow line on these two charts, versus the US dollar index, that's the pink line, the Dixie. You can see at the start of COVID and at the start of the GFC that gold fell, and gold's fallen at the start of the Iran war, but over time gold outperformed the US dollar. So gold became stronger and the US dollar became weaker, and that's what we've already started to see through to a couple of days ago in the Iran war. You can see gold being the yellow line there, fell a lot during March at the start of the Iran war, but then it started to bounce back. And the US dollar there was a flight to liquidity, if you like, which always happens during crises. Then as things sort of, if you like, settle down slightly, you see gold recovering, and that's been happening this time, and I think we're going to continue to see that. Just in terms of equities, this is Australian gold miners and the amount of money amount of cash that they're making and that they're sitting on. So there's been a huge amount of cash made by gold miners in particular, other miners as well, and that is expected. You know, they do a number of things with their cash. They do mine expansions, they have dividends, and they buy back their forward hedge book, most of which have been completely cleared out now. So we expect to see mergers and acquisitions, takeovers by these cashed up companies in the sector increasing as we go forward. This is a question, I just put this slide in, just a bit of a side comment here, a question I've had quite a bit about the effect of rising fuel prices on mining company margins and profits. And it's interesting to see the difference on the your left-hand side is open pit costs. Open pit mines generally require more diesel. You can see energy at 16% of their operating costs. Underground mines, because they're not moving as much rock, they don't require as much diesel, energy is significantly lower. So if you're going to have higher fuel prices, everything else being equal, you probably want to be in an underground, higher grade mine versus a lower grade, large open cut mine. Just talking about natural gas, something that we are increasing our exposure to at the fund. You can see while gas prices in the green line in the US have stayed or even fallen through March, gas prices globally have risen significantly in Europe and in Asia in the red and the blue lines. Oops. So just also on energy, uranium, I think the fundamentals for uranium were very strong even before the Iran war. But the Iran war has been a wake-up call. I'm hoping it'll be a big wake-up call for governments around the world in terms of their independence of energy supply. So I think you can see even more interest in nuclear energy than we would even otherwise have had. And just example there, Taiwan, which had a no nuclear policy for at least the last decade, is turning back on two of its nuclear power plants. Just lithium, also important in terms of energy. There's been a lot of new interest in EVs, of course, as a result of fuel prices going up. This is an investment we made a number of years ago in a lithium company. It's fairly typical, I think, for share prices of junior resources. They can go sideways and nowhere for a number of years, and then, if and when they make the big discovery, they can really take off. So, the fund's investment cost there was around 25 cents per share, and then ended up selling out at up to or over $3 a share. So that's the sort of returns that you're looking for when you take the risk of investing in junior resources. The lithium price, this chart doesn't go back quite far enough to say the first lithium boom, but you could say we've had 3 lithium booms over the last 10 or 12 years or so. The one during or at the end of COVID was the biggest. But I think with the renewed interest in EVs in particular, but also the just growing energy demand and the need for batteries, stationary batteries, we're going to see lithium take off again, and we've already seen it double over the last 12 months. But in terms of the lithium market, it's actually very small. So that big blob there is the oil size of the oil market in dollars, and you can see down on the left-hand side there, the lithium market is tiny in comparison. So it's very easy for a small market like that to swing from oversupply to undersupply and back again. And I think what we're seeing at the moment is an undersupply and a market squeeze, which is probably not going to be resolved in the short term. This is a chart of Google searches for EVs as a result of the Iran war. So interest in EVs is obviously taking off. And inventories are actually very low in lithium. So lithium is something at the fund that we're trying to build our exposure to. I think I'm pretty much out of time. So I will say thank you very much. Please come past the booth and put your name down to go in the draw to win the silver coin. Thank you very much.